Owning a home, it's pretty much the foundation of the American dream, right? But what if the very thing that makes it possible for most people, the 30-year mortgage, isn't actually a key to that dream? What if it's the lock on a trap designed from the very beginning to keep you paying? Let's dig in. So, we're going to explore a really powerful idea today, that the entire mortgage system as we know it was built to keep the average person locked in a cycle of debt. And that forces us to ask a pretty uncomfortable question. Is the dream of owning a home actually just a carefully constructed financial illusion? Whoa. I mean, that is a shocking thing to hear. It suggests the system isn't just flawed, but that it's actually working exactly as it was designed to, which is for you to never truly get ahead. To see if there's any truth to that, we have to rewind the clock and look at how the modern mortgage was even invented in the first place. Before the 1930s, buying a house was a privilege. It was something reserved almost exclusively for the super wealthy. The way mortgages were set up back then made them completely out of reach for the average person. Just look at how different it was. Before the 1930s, you needed a 50% down payment, half the cost of the house, right up front. And for 5 years, you paid only interest. Then, at the end of those 5 years, you owed the entire other half of the house in one giant payment. It was a system built for the rich, period. But then the Great Depression came along and changed everything. The government stepped in and created the Federal Housing Administration, the FHA. And it did one crucial thing. It started guaranteeing home loans. So if a borrower defaulted, the government would pay the bank back. Suddenly, all that risk for the banks? Poof, it was gone. And they were more than happy to start offering longer loans, like 10 or 15 years, with much smaller down payments. And with all this new access to credit, home ownership absolutely exploded. But you know what happens when demand shoots up, right? So do prices. Pretty soon, even a 15-year loan started to feel like a stretch for a lot of families. So the banking industry came up with a brilliant solution, the 30-year mortgage. It made that monthly payment look so low, so affordable, it was irresistible. But that affordability came with a massive, massive hidden cost. And this is where we get to the real heart of the trap. It's not the loan itself. It's how the interest is structured over that super long 30-year period. The numbers here are just staggering. Let's take a $100,000 loan. On a 10-year term, you pay about $29,000 in interest, okay? But if you stretch that exact same loan to 30 years, the interest skyrockets to over $93,000. That's not a small difference. You're basically paying the entire price of the house all over again, just in interest. And the tool the banks use to make this happen is called amortization. Now, amortization sounds like a complicated financial term, but the idea behind it is actually pretty simple. It's just a payment schedule where, in the early years, almost all of your monthly payment goes directly to interest. For the first several years of a 30-year loan, you're barely making a dent in what you actually owe. You're just paying the bank for the privilege of borrowing their money. This is the key illusion. We're all trained to hunt for the lowest possible interest rate. But what this shows is that the real enemy isn't the rate, it's the time. 30 years is an eternity for interest to compound against you. And this whole system is perfectly designed to take advantage of our modern, mobile lifestyles. I mean, think about it. A century ago, people might buy one house and live there for their entire life. That is just not how most of us live anymore. And this change? It plays directly into the hands of the banking system. Get this. The average person will change jobs about 11 times in their career. A lot of those changes mean moving to a new city, so the chances of you staying in one house for the full 30 years are almost zero. And every single time you move, you fall right back into the bank's trap. Here's exactly how that cycle works. You get a 30-year mortgage. For the first 7, maybe 10 years, your payments are almost all pure profit for the bank, barely touching the principal. Then life happens. You get a new job, your family grows, so you sell and move. But when you buy that new house, you get a new 30-year mortgage. And that amortization clock, it resets right back to day one. You get stuck on this treadmill, running hard, but basically going nowhere. Every time you move, you think you're building equity, but in reality, you've just spent years and years paying the bank's interest, not building your own wealth. You're constantly starting over from square one. So, if the game is rigged, how do you beat it? Well, you don't win by playing the game the bank's designed for you. You win by learning their rules and then creating your own. So, here are 3 rules to play by. First, just understand the system. Knowing that time is the real enemy gives you a massive advantage. Second, you either commit or you wait. If you can't honestly see yourself staying put for at least 10 years, buying might be a huge financial mistake. And third, pay it off as fast as you can. Use every strategy you can think of, making biweekly payments, adding extra to the principal, to slash years off that loan and escape the interest trap completely. Now, this isn't an argument against owning a home, not at all. It's an argument for true ownership. The goal shouldn't be to just have a mortgage. The goal should be to own your home, free and clear, without becoming a permanent source of income for a bank for 30 years. So that really leaves us with this final thought. The 30-year mortgage, for sure, it made homeownership accessible to millions of people. But it also created a system that can be incredibly difficult to escape. By understanding the math and the incentives, you can choose to play a different game entirely. The only question is, what's your strategy going to be?